They tried to kill crypto, not with outright bans, but with quiet suffocation. They choked off access to banking. They labeled everything a security. They flooded the space with lawsuits, subpoenas, and headlines meant to scare innovation into silence. Founders were arrested. Exchanges were blacklisted. Banks were advised to stay far away. And it worked, at least on the surface. Projects shut down. Startups moved offshore. Billions in capital fled to safer ground. The message was clear. You're not welcome here. But while the spotlight dimmed, something shifted in the shadows. Because regulators didn't walk away. They looked closer. And what they saw surprised them. Not meme coins. Not Ponzi's. Not anarchist software trying to burn down the system. They saw blockchains that were quietly compliant. Chains that didn't fight regulation, they anticipated it. Chains designed not to disrupt governments, but to serve them better. And now the script is flipping. The same agencies that once warned of systemic risk are now exploring how to integrate the tech they tried to stop. The FDIC is testing digital deposit models. The Treasury is investigating blockchain settlement rails. The Federal Reserve is quietly engaging with permissioned DLT pilots. And here's the twist no one saw coming. The chain they're most likely to adopt isn't the one you think. Not Bitcoin, too volatile. Not Ethereum, too fragmented. Not Solana, too chaotic. Not a meme. Not a DAO. Not a vaporware roadmap. But a blockchain that's been regulatory grade since day one. One that runs fast, final, and frictionless. One that was never built for hype, but for integration. It didn't scream for attention. It didn't chase Twitter sentiment. It didn't need to, because it knew its moment would come, when the regulators stopped fighting and started building. And now that moment has arrived. The FDIC just flipped, and this quiet, overlooked crypto is not just back. It's perfectly positioned to power the next financial era. The war on crypto. For 2 years, it felt like crypto was under siege. This wasn't a misunderstanding. This wasn't regulatory uncertainty. This was targeted, deliberate pressure, a silent crackdown disguised as consumer protection. They called it Operation Chokepoint 2.0. And whether you believed it or not, the pattern was impossible to ignore. First, the banks backed away. Silvergate collapsed. Signature went down. Custodia was denied a Fed master account. Then came the lawsuits. Ripple, Coinbase, Binance. Even protocols like Uniswap and MetaMask started lawyering up, because no one knew who would be next. Everything was a security. Everything was high risk. And any company caught too close to crypto got a quiet phone call or a public warning. Behind the scenes, founders stopped sleeping. Teams moved overseas. Projects that were once proud to be U.S. based, restructured or disappeared. And for a while it worked. Crypto volume plummeted. VC investment dried up. Developers left for other industries. The message was loud and clear. You can build your future. Just don't build it here. It wasn't just enforcement. It was isolation. Banking access was cut. Stablecoin issuers were stonewalled. Conferences were infiltrated. And politicians used crypto like a political prop. One day calling it the future, the next calling it a threat. Retail lost faith. Startups lost capital. And even the biggest advocates in DC stopped speaking up. Crypto became a dirty word. Not because it had failed, but because it refused to fit the mold of the legacy system. And so the government tried to erase it, not with a ban, but with silence and pressure. But while the headlines said, crypto crackdown, something else was happening in the background. Regulators weren't just attacking crypto. They were studying it. And not to kill it, but to understand how they could use it themselves. That's where everything begins to change. The silent shift. While the public headlines screamed, crypto is over, behind closed doors, a different conversation was unfolding. It wasn't happening on Twitter, not in press conferences, not in Discords or influencer threads. It was happening in think tanks, policy groups, and private roundtable sessions with titles like The future of money. Digital settlement architecture. Tokenized banking infrastructure. And the people in those rooms? They weren't Deegans or startup founders. They were executives from the Fed, FDIC, BIS, IMF, and the biggest payment networks on the planet. Because here's what few realized. The government never hated the technology. It hated the chaos surrounding it. What they feared wasn't blockchain itself. It was volatility, anonymity, fraud, and lack of control. So while the crypto headlines focused on price charts and lawsuits, regulators began shifting their lens from, "Should we kill this?" to, "How do we make this work for us?" The clues were always there. The Federal Reserve launched FedNow, a real-time payment network eerily close to blockchain in functionality. The Treasury began issuing RFIs, requests for information, on tokenized assets and digital identity. The BIS released multiple papers on regulating tokenized deposits and DLT-based cross-border payments. And the FDIC? It quietly began exploring how blockchain could support insured digital dollars, faster interbank settlement, and even a new category of tokenized commercial bank money. First, it was slow, tentative, skeptical. But something changed in 2024. The failures of traditional infrastructure, slow payments, high fees, reconciliation delays, became too obvious to ignore. And meanwhile, blockchain infrastructure quietly matured. No more vaporware. No more over-promising protocols with no devs. The chains that stayed, the serious ones, had proven uptime under pressure, transparent ledgers, compliant tooling, enterprise integrations, real-world use cases. Suddenly, the government wasn't asking if blockchain was viable. It was asking, which one can we actually trust? And that's when the hidden players came into focus. Not Bitcoin, too slow, too rigid. Not Ethereum, still battling its own complexity and congestion. Not Solana, not Avalanche, not Polygon. They needed a chain that was fast enough for global payments, secure enough for interbank settlement, flexible enough for public-private deployment, built from the start with regulation in mind. And just like that, the spotlight shifted to a blockchain no one was watching, the chain they can actually use. When regulators finally decided to stop pushing crypto away and start pulling it in, they weren't looking for hype. They weren't searching for yield farming, token burns, or community airdrops. They needed something clean, tested, auditable, boring in the best way. Something that could actually plug into the US financial system without blowing it up. And that's why, when the dust settled, only a handful of chains were left in the conversation, and one stood out. Not because of market cap, not because of social sentiment, but because it had been built from day one with three unsexy, but critical pillars: compliance, performance, integration. Let's talk specifics. Built-in compliance. This blockchain didn't treat regulation like an afterthought. It was engineered for it. KYC modules, transaction-level audit trails, identity hooks, configurable privacy layers for enterprise, support for hybrid deployments, public when needed, permissioned when required. This chain didn't need to be retooled for banks. It was already ready for them. Enterprise speed and stability. This wasn't a maybe one-day protocol. This chain was already handling sub-second finality, micropayments at scale, energy-efficient consensus mechanisms, near-zero fees, no downtime even under network stress. Compare that to Ethereum, where gas fees fluctuate wildly, or Bitcoin, where finality takes an hour, or Solana, which, for all its speed, has been known to freeze. This chain has been shipping quietly without headlines but with results. Real-world use. Most blockchains talk about real-world adoption. This one actually has it. Used by governments for digital identity pilots. Used by banks for tokenized cross-border payments. Used by logistics firms for transparent, secure data exchange. Partnered with global standard bodies like ISO and the ITU. Running production pilots with institutions, not testnets for clout. While the market chases meme cycles, this chain has been integrating into the system that runs the real economy. That's why, when the FDIC began exploring tokenized bank deposits, when the Treasury began running simulations for real-time settlement. This chain's architecture started showing up in the background, not as a replacement for the dollar, but as the invisible rails that move it faster, safer, and smarter. So which chain is it? Could be ALGO, which already powers digital ID in Africa, CBDC tests in Europe, and has instant finality. IOTA, designed from the ground up for secure data exchange, machine-to-machine payments, and regulatory compliance. XDC, a rising trade finance powerhouse built to be ISO 20022 compliant, already integrated with banks in Asia and the Middle East. Or INJ, which has shown promise in high-frequency financial applications and decentralized derivatives, now evolving toward enterprise utility. Each of these projects isn't fighting for retail attention anymore. They're being courted by institutions who've realized, we don't need the most popular chain. We need the one that works within the law and at scale. The irony? These chains were laughed at, ignored, called boring, too centralized, too quiet, too corporate. But now that's exactly what makes them viable. Because regulators aren't looking for wild innovation. They're looking for stability. And now they've found it, in the chain they never expected. This isn't just a redemption arc for one forgotten blockchain. It's a signal that the entire game has changed. For over a decade, crypto was defined by its rebellion. Against banks, against regulators, against centralized control. And for good reason. In a world of bailouts, inflation, and financial surveillance, crypto offered a different vision. Open, borderless, decentralized, free. But here's the truth we've finally arrived at. If crypto is ever going to power the infrastructure of the real world, it has to work with the systems that already run it. This moment, the FDIC flipping, government agencies exploring DLT rails, institutional use cases going live, it isn't the end of crypto's ideals. It's the evolution of them. The next phase is integration. We're entering a new phase. Not hype, not speculation, but infrastructure integration. That means chains that comply with existing financial laws, assets that settle in real time with auditability, tools that plug into core banking software, not crypto wallets, stable coins that meet regulatory standards, not just Deegan yield targets. Cross-border payments that work inside the legal system, not around it. And only a few chains are built for this. Even fewer are already being tested inside that system. This changes everything because it proves crypto doesn't have to fight the world to change it. It can power it better, faster, cheaper, and more transparently. The regulatory pivot isn't temporary. What we're seeing isn't a one-off experiment or soft policy reversal. It's a structural pivot. The FDIC isn't trying out crypto. It's laying groundwork for tokenized banking models. The Treasury isn't curious about blockchain. It's working with global agencies to define how public ledgers can enable real-time, regulated financial flows. This shift will lead to new categories of regulated digital assets, hybrid ecosystems of public permission blockchains, mass adoption of crypto without users even knowing it's crypto. Banks, fintechs, and governments relying on the same chains we once called altcoins. It's the transition from narrative to necessity. The market still doesn't get it. Most of the market is still distracted. They're watching meme coins, L2 launches, and influencer hype. But the real movement, it's quiet, institutional, systemic, and that's exactly why it matters. Because by the time the public notices what's happening, the infrastructure will already be live. And the chain they laughed at in 2022, the one they dismissed as too quiet, too compliant, too boring, it will be running the very system they use every day without realizing it. The chain they tried to kill is now powering the system. They tried to kill crypto, cut off its banking, crushed its public image, and pushed its builders into the shadows. But while the spotlight turned to lawsuits and market crashes, one blockchain kept building. No hype, no headlines, just quiet, regulatory-grade engineering. And now, while most of the market still waits for the next bull run, this project isn't waiting. It's being adopted by the very system that once shut the door on crypto. By institutions that don't care about memes, they care about reliability. By regulators who finally understand. Crypto wasn't the problem. The wrong kind of crypto was. This is a different story now. Not one of rebellion, but one of relevance. Not about destroying the system, but upgrading it. Not about price action, but about purpose. Because when the FDIC flips, when governments test stablecoins on your rails, when regulated banks start tokenizing deposits using your chain, that's not speculation anymore. That's adoption. And the quiet chain they tried to kill, it didn't die. It just waited for the world to catch up.